Pattu from freefincal. Let's take a look at Kotak International REIT Fund and in particular ask what kind of return one can expect from this. The moment people think of real estate or a real estate investment trust, which is a REIT, they think that they will get steady income in the form of rent and they'll get capital appreciation without understanding about market risks. The same is the problem in the case of debt funds. For example, many people even today think that if they buy a gilt fund, it has got no risk, without understanding that if you buy a sovereign bond individually and hold it, there is practically no risk until you wish to sell it in the market. But if you wish to sell it, then it will be subject to market fluctuations. But the problem is in a debt fund or in a real estate investment trust, which is basically a kind of mutual fund for real estate, where investors' money is pooled in to buy real estate and give out rental income as dividends. The problem is that the NAV of the REIT fund will fluctuate every day as per the market supply and demand. Therefore, the risk is significant. Because usually when we talk about real estate stories, we say my uncle made 5x, my auntie made this much, and so on. All these anecdotal evidence. There is practically no market in India. There is no market that's actually trackable and actually regulated. It's completely unregulated. Even today, if we talk about black money in real estate and so on, from that kind of a mindset, if people want to invest in a REIT fund, they have to be very, very clear about the underlying risks. So REIT is basically it's just an equity fund that's invests in real estate. If I'm not wrong, for Indian REITs, 90% of the rental income should be given out as dividends to the holders. Whereas in this case, which is Kotak International REIT Fund, this will invest in this SMAM Asia REIT fund, which is basically will invest in Asia Pacific real estate. At the moment, it has got about 40% in Singapore. That's probably the smallest country, but it's got the maximum exposure there, except Japan. And the AMC is actually domiciled in the Cayman Islands. So the trust fund will be in USD, and it will not be in it's a Japanese AMC, but they are domiciled in the Cayman Island, so it will not be in terms of yen, as somebody asked. It will be in USD. So whatever dividend that the REIT will give, the Kotak AMC will reinvest it back into the FOF, and that includes for capital gains as well. So you have to be very clear that the risks is basically on an everyday basis. The risk is significant, as we'll see. It's almost as much as equity markets and gold. And you can have problems because of pandemic. You can have credit risk where the person may not even give you the rent, and it may be difficult to sell, liquidity issues and so on. So the lot of the same kind of problems that bonds have, corporate bonds have, REITs will also have. So this picture here shows the red line is the NAV with the dividends reinvested, and the blue line is the NAV, the ex-dividend NAV. So you can see the huge difference. That's the dividend plays a huge component in the REIT returns. That is why if you look at all the brochures, they will never talk about risk, but they will keep talking about dividend yield and so on. That's to distract people into not looking at the actual risk. So now let us now compare where the risk and reward, to find out where this real estate investment risk actually lies. So we're going to make a comparison here. This is first on the left is S&P Sensex, then you have the REIT, then you have S&P 500. This is gold base, and this is the 10-year sovereign bond. So this is the last 3-year risk versus reward. I have plotted in terms of decreasing risk, and you can notice here that the rate volatility, the risk here is the annualized risk, which is basically the standard deviation of monthly returns, or how much the NAV fluctuates on a daily basis. You can notice that the rate volatility is comparable to that of S&P 500, the BSE Sensex, and gold. So that's over 3 years. And now if you look at over 5 years, the rate is again here, and it's only a little bit less volatile than the Sensex, and it's more volatile than the S&P 500, more volatile than gold. And I've also done it for 10 years, where that's where more or less it's similar. And you can also see from this graph there's no correlation between risk and reward. That is, people say higher the risk, higher the reward. That's just nonsense. There's absolutely no correlation. Just because you take higher risk doesn't mean you will get higher reward. That's just bullshit. So in order to actually find out more about what return one can get from this rate, I took the NAV data, the chart, and I digitized it using a software called WebPlot Digitizer. I have a long history of digitizing data in physics, so I know which tools to use. It's not easy. Even today, it's a pity that digitizing graphs, that technology is not yet, it is not advanced. Whatever was available 10 years ago seems to be this same state now. That's a pity, probably because there's not much demand for it. But if anybody knows a better tool, which you have actually tried, let me know. So I have digitized it, taken out the points from the red line, and I have plotted the rolling returns. It's a very approximate estimate, but that's good enough just to tell you what kind of risk you can expect from this rate. You can see the returns fluctuate from about -4% to about 14% over every 3-year windows, and over 5 years it fluctuates from 2% to 10% roughly. So basically no one knows what return you will get. It's just too risky. This makes no sense, because anyway you are only going to add only a little bit into the portfolio for diversification purposes, as is amusingly called. I don't know what that means. There's no point adding something so risky and just adding a little bit. Anyway you're going to only add a little bit. This just makes no sense. Don't waste your time with this international rate fund of fund. Give it a miss. Bye bye.